Hi guys, it's Marissa Schultz here from Rise High. Welcome to another episode of Rise High TV Live, where today we are talking about refinancing. Everything you need to know about refinancing, and I'm joined by the wonderful Priya Ravi, who is one of our wonderful mortgage brokers on the Rise High team. And we are going to be answering all of your questions about refinancing, debt consolidation, reviewing your loans, to make sure that we can be of maximum value to you over the next 30 minutes or so. We have already received a number of questions which we will be answering live tonight on the segment, but of course we do love interaction from our audience, so please, if you have any comments, questions, suggestions that you want to send through, you can do that by leaving a comment in the notes below, or you can send an email to amanda@risehigh.com.au and she will be monitoring that for us tonight. So let's get started, and before we do, apologies that we were a little bit late today. We had a few technical difficulties, but it seems to be that we're on track again. So, and I should point out that Priya, this is her first Facebook Live, so she's pretty excited, yes, pretty nervous. So I think she'll be great. So, but she is an expert on this topic, and I'm really looking forward to having her input and contribution. So Priya, let's talk about refinancing. Let's just start broadly with what is refinancing? What does it mean to refinance?
So refinancing essentially is moving your existing loan with a lender to another lender and paying out the existing loan and starting a new loan with a new lender. Or you could also consider internal refinance, where you restructure your existing mortgage to just get a better structure and easier way to handle your loan.
So a refinance doesn't necessarily mean you're moving bank. It might mean moving bank if that is the best option for you, but it may also mean staying with your existing bank but getting a better deal or a better structure.
That's right. Yeah,
absolutely. Awesome. Okay. I'm going to delve into the questions that we've got, because we've got quite a few. Yeah, the first one that I'm going to address is the question from Celeste.
Yeah.
She asked, why should you consider refinancing? She wanted to know the pros and cons. Yeah. So let's talk about the pros first. Like, what are the reasons that people might consider refinancing?
The main reasons that you might want to consider is, what sort of interest rate you're on. Are you going to get a better interest rate? Second, is it going to lower your repayments? Are you going to save more money? Also, you might want to consolidate debt like personal loans and credit cards. You might want extra money for renovation. So there are multiple purposes that you might come across. So at that sort of juncture, you can reassess your current situation and see what's going to be beneficial for you, essentially.
Yeah. So obviously saving money is a massive reason why a lot of people consider refinancing. But as you just said, there's so many other reasons that refinancing might be important, and it might be that your current lender, your borrowing capacity is limited with that lender, and to do what you want to do and get the extra money out that you want to get out, or look at what you want to do, you may need to consider other lender options. So that's where refinancing also plays a role.
Absolutely,
Yeah, awesome. Okay, so there's sort of the positives. What would you say are some of the negatives involved in refinancing that people need to be aware of?
The things that, again, you have to consider when you do look at refinancing is, one, the costs of refinancing, whether it's beneficial for you to spend that money to refinance, and how long it's going to take you to recover those costs. Secondly, are you in the correct situation financially, income-wise, to be able to...
So do you have the borrowing capacity?
Borrowing capacity, absolutely. Do you have the value?
And that has changed in recent times for Australians. Borrowing capacity has got a bit tighter for everyone. So that's obviously something that you can't take for granted and something that you need to explore.
Correct. Yeah. That's right. And also, I mean, there might be things like your value of your property might have gone up. You might want to consider also like your living expenses, which are now a topic that have always come up, and lenders are getting stricter on that. So those are the sort of factors that you might want to think about as cons.
So just to summarise, so there's a lot of positives. You can save money and achieve your goals and do what you want to do, but you need to be aware of the costs, and you need to make sure that you're managing your borrowing capacity and ensuring that it's all sort of going to work out for you.
Yeah.
Okay. hopefully that addresses your question, Celeste. Thanks for the great question. Angus actually wanted to know, he said, how often should you review your home and investment loans?
Ideally, you'd want to review your home loan every 12 months at least. Whether you're going to look at refinancing or not, it's best to assess, where your loan is. Is there better products available to you? Is there better interest rates? Can you
Such a good suggestion.
save money? So best is to review your loan every 12 months and then, obviously talk to your mortgage broker and see what they suggest and see if you can find anything better.
Because, the unfortunate thing in today's reality is that big banks will generally look after new customers before existing customers, which is really sad, but that's the truth. So what you find is that you might be on the best rate for you at the time that you get your loan.
Yes.
But 12 months, 24 months, 3 years later,
that's right.
You're actually getting ripped off with your interest rate versus new customers to that same bank are getting much better discounts. So, it's so important to review your loan regularly, isn't it?
Yeah, absolutely. And, and any chance of you paying less interest to the bank, you should be able to make use of that opportunity to swap over. And as Marissa said, the banks do look after the new customers and not the existing customers, and hence why we're here to ensure that we're here
to look after you for the life of the loan.
True.
So Angus, definitely every 12 months. But I would also add to that sometimes it's important to review more frequently than 12 months. Like for example, if your circumstances change, what are some examples that you can think of that would trigger that?
Anything whereby you might want to review sooner. Say, for example, if you feel the value of your property has gone up.
Maybe you've done some renovations to yourself, like by yourself, that hasn't cost you a lot of money, but you've internally, cosmetically improved the property, and you want to access some equity to do something else.
Yeah, absolutely. Or say if you've been working in a new job, you've got more borrowing capacity. You might want to look at future investment potential.
That's a great point, because sometimes, whatever your situation is at the time that you buy your home or buy your investment property, you get the best loan for you at that point in time based on your personal situation.
That's right. Yep.
And depending on what your situation was, it might be that your borrowing capacity was limited to a certain number of lenders.
Correct.
Whereas when your situation changes, it may be that opens the options available for which lenders
that you could go to. You might have more of a choice whereby the lender will sort of work harder to give you a better deal even.
Absolutely. And that can also be true when someone comes off of comes out of a construction period, for example.
Absolutely, yes.
Sometimes the best loan for you during the construction period may not be the best loan for you when the construction's finished, or if a customer comes out of the lender's mortgage insurance territory.
Correct. Yeah.
So
as well, yeah. And even if you've been say for example you're on an interest only loan and you want to change that back to a fixed or a P&I variable, so you might want to think about refinancing at that stage and see.
So there's lots of different stages that you could consider refinancing. Absolutely. So hopefully, Angus, that helps you out to answer your questions. Of course, we do offer fee-free reviews of loans, so you have nothing to lose if you'd like us to help you to review your loans for you. And Priya would certainly be very
anytime
happy to assist.
Happy to assist.
Okay, Kieran wanted to know, this is a bit of a double up, but Kieran wanted to know when is the right time to refinance. So we've already gone through a few examples. Are there any other examples you can think of, Priya, that we could add to that?
There are a lot of stages that you can consider refinancing. Example, when your circumstances change, so not just employment, say you've had extra savings, or you might have had another child, you want to move into a bigger house. So there are many different things that could want you to relook at your loan and and look at the options of refinancing. Maybe you want to buy a bigger house. You might want to do some renovations to your existing property, see if you can sell it, and then move on to purchasing a different house or investments perhaps. So a lot of things to consider there, and of course interest rates and
and let's face it, interest rates have been crazy lately. The fluctuations and the variation between the interest rates and the different lenders.
Absolutely,
it's it really is so important that you review your loans and that you do look at whether refinance is going to save you money, because for most Australians, it's our biggest living expense.
Correct.
You know, your mortgage is a massive expense.
Yes.
If you can shave $100 a week off the loan, that's $5,000 a year. You know, it's a significant amount, you know, that is worth saving. So every little bit counts.
Yes, absolutely. And, you know, again, if that $100 means that, you know, you send your kids to a soccer game or
private
any sort of
school, or you could go on a holiday.
Absolutely. So many different things that you could do with that little bit of extra cash. So
absolutely,
it's always, you know, best to keep on top of your.
I say
your
it's better in your pocket than the bank.
Absolutely, that's very true.
Okay, let's move on to the next question. Hopefully, Kieran was satisfied with that answer. Laura wrote in and she wanted to know how much does it cost to refinance. So let's go through some of the costs involved in refinancing. So people understand what the costs are.
So the main costs of refinancing are one, your mortgage discharge from the lender or
from the outgoing lender.
Yep. And that can usually vary anywhere between $150 to say $400. You've got your mortgage registration fee from the government, and then you probably would also have to consider your establishment fee, which is your new application fee that your new lender might charge you. You've also got to think about, you know, if you were going to go on a package, the package fees, or if you're in lender's mortgage insurance territory, then obviously lender's mortgage insurance as well has to factor in that, and then compare that to the benefit you're getting from it over a few years time, and and that's probably how you can assess, you know, whether the.
So how do you help clients to work out whether, you know, the cost benefit analysis is worthwhile? Like, how do you help them to analyse the costs involved in refinancing and compare it to the benefit they're going to gain from a cost perspective to ensure that it is actually going to put them in a better position? What's the process that you go through, and what do you present to the client?
So what we kind of work out is, you know, how much of a better interest rate are you getting? What is the amount of your loan? And on a yearly basis, how much interest you're going to save from the banks? And then we'll also look at all the costs that you're going to incur from moving or doing the refinance, and see over like a 3-year time frame what you've actually benefited from doing so. And for example, if you've got a loan of, you know, $500,000, you're getting a 1% better rate. And so that in itself, you can directly see that it's going to give you a benefit of about $5,000 per year. So when you look at that versus the cost of what you're going to incur when you refinance, you can definitely see that there's going to be a huge benefit to you. You know, even if it's $4,000 in the first year, and then you are still kind of gaining each year on a better interest rate. So
do you put sort of a table together for your clients that sort of spells it all out in a really clear, easy to follow way?
Yeah, absolutely. And I recently did a loan comparison table for a new client, and was quite impressed with, you know, the way we set it all out. It was very clear. It detailed.
So they just give you the information about their current loan, and then you go and do the research. You find all the lender options, and then you present some options to them as to what would be best for their situation and the potential savings.
And absolutely, and each one's requirements may be different. Somebody might want to go on a package with all the perks, and someone might just want a straight variable rate. So we do kind of check with the client what they would like, and based on that do that sort of a comparison table for each different aspect. If you want a fixed rate, for example, or if you just want to go on a variable, we kind of show them a comparison as well.
Okay, so hopefully, Laura, that's helped you to understand the cost. So generally, you'd say maybe up to $1,000 to refinance.
Roughly around about $1,000.
Depending on your situation, it could be less, could be a bit more, but make sure that you understand the costs up front before you proceed. Greg wanted to know if the refinancing costs could be added to the new loan. So let's talk through that.
Sure, absolutely. I mean, the refinancing costs can be worked into the loan.
Yes.
So when you move from one bank to the other, we just adjust the new loan amount accordingly, just so that you're not out of pocket by having to, give give that money to the bank.
And when you do that, do you also take that into consideration when you're doing the loan comparison table?
Yes, absolutely.
So that the borrower can really understand what the...
So what we do is we factor in all the costs that you are going to incur, and obviously we do explain that you don't have to pay that from your bank or out of pocket. We can include that, and this is how it's going to affect your repayments.
Excellent. Okay, Greg, there you go. Yes, they can be added to the loan. Now, Charlie wrote in.
Mm-hmm.
Charlie says, I purchased my first home last year and had to borrow 95% of the purchase price. At the time I had to pay lender's mortgage insurance. My interest rate is high. Can I look to refinance to another lender to get a better interest rate? Okay. What would you say to Charlie?
So if Charlie came to me with a situation where he has originally bought the house with lender's mortgage insurance, the first thing that we would look at is the value of the property and see if the value has increased by any chance.
And how do you do that?
So what we would do is, either we order a valuation depending on whether there's a lender available.
And is there any cost to the client to order a valuation?
I mean, we can, as brokers, depending on which lender we might choose, we can order a free valuation for the client.
That's great.
So it's amazing that we're able to do that. And secondly, not only do we look at the value, we also look at whether the clients had any extra savings, for example, that they could put into the loan. Now, just because the interest rate is lower, it doesn't necessarily mean that you're not going to incur lender's mortgage insurance. So that's something that you should consider.
So we have to factor that in before we decide to refinance. So maybe, Charlie, you should speak to Priya, get your house valued before you consider refinancing, and then you can actually work out what it will potentially cost you. Because unfortunately, lender's mortgage insurance is not transferable across lenders.
Right. Yeah.
So there you go. But the good thing about lender's mortgage insurance is that if you have paid it with a particular lender and you need to do an equity release once you've got some equity in that property, and that again incurs lender's mortgage insurance, we can normally get that deducted against what you've already paid if you stay with the same lender. So we can help you through all of that. Before we go on to the next question, I want to do a shout out to James, Emily, Sarah, Victoria, Greg and Susan. Thank you so much for tuning in, guys. It's great to have you here tonight. Hope you're enjoying the segment. Let's move on to Kane's question.
Okay, excellent.
So Kane wants to know, what does it mean to consolidate your credit cards and personal loans?
So consolidating your credit cards and personal loans is to try and be able to perhaps put those loans in together with your actual home loan as an option. And
what are some of the benefits of doing that?
Some of the benefits of doing that is that it can reduce your repayments considerably, because you are going on to a mortgage interest rate rather than your credit card or personal.
Some of those credit card rates can be ridiculous.
Absolutely.
Like 14 to 20%.
20%, that's right.
Versus paying, less than 4%, 3.5% for, against your home loan. Like, there is a massive difference.
Yes,
do you find that it could potentially help people to get on top of their credit card debt a lot faster if they can reduce the interest rate?
Yeah, absolutely. And I think, people may find it really hard at that 14 to 20% rate to be able to pay that card down when they've already got, say, a mortgage and other expenses. So it's definitely something to consider, and see if you can consolidate it into your home loan. So it's good to ask us as your mortgage broker, or we will also look at it for you.
I think I'm going to add something there, because with credit cards and personal loans and car loans, obviously you don't want to consolidate them into the home loan and pay them off over a 30-year term. You want to clear the debt quickly.
That's right. Yeah.
So it's a good idea to have that as like a separate loan secured against your house, maybe over a shorter term. So if you are planning to try and get rid of those credit card and personal loan, car loan facilities, it's a great idea to talk to your mortgage broker and help them to understand what you can afford to pay on a regular basis, and how quickly you want to get that debt down and get rid of that debt, so that you can actually be free from that expensive, horrible debt, and be able to move forward feeling a lot more in control and free with your finances. So do you agree, Priya?
Yeah, absolutely. And I think, as Marissa said, the loan term is very important, because you don't want to be paying it off over the 30-year time frame. So it's good to consider, all right, would I want to pay it off in 5 to 7 years, for example? Or, and depending also on what your personal loan or credit card was previously at. I mean, with credit cards, you don't really have a loan term as such, but with personal loans, perhaps, you only had 2 years remaining. So those are things to consider when you are looking to consolidate your debt.
Excellent. Okay, we have some more shout outs to Corey, Craig, Richard, Eva and Layla. Thank you so much for joining us, guys. Really appreciate having you here tonight. Once again, please feel free to leave a message or a comment or a question before we wrap up. We've probably got about a few more minutes to go before we wrap up for this evening. There is another question that's come through from Sean. He wanted to know what the pros and cons of consolidating credit cards and personal loans are. I think we've already touched on that a little bit, but
absolutely.
Let's just wrap that up.
Yeah, sure. So, I mean, your pros are that, you're going to reduce your monthly repayments to lower repayments based on your...
So help with cash flow.
Cash flow, absolutely.
Save money.
So you've got...
Pay down the debt sooner.
Absolutely. So those are all your pros. The cons could be that, again, consider like your time frames and the number of years that you're going to do it over.
I think the other thing as well, if I can just butt in, is that, if you are going through the process of trying to get rid of unwanted credit card and personal loan debt, you really want to make sure that you change your spending habits along with that.
Correct.
So that in 6 months' time, you don't end up in a position where you're just racking up the credit card debt again to have to do that again. So it's a matter of, if you're going down that process of consolidating the credit card debt, having a think about how you're going to eliminate the need to build up that credit card debt facility again in the future.
Absolutely.
So do you help your clients
sort of
work through that and help them to
and now that we sort of, with the whole Royal Commission and living expenses, we do kind of talk to all our clients and just say, look, these are the areas that, that are getting stricter in lending. So kind of see if you can, pay down your credit card rather than sort of reusing and increasing a debt situation again. So those are discussions that we do have, and if there's any way that we can assist you in achieving those goals for your future, you might be able to then save more money to buy yourself another investment property, or like you said, you can free up so much money to do so many different things, like go on a good holiday, take your kids out. But so we do kind of discuss that. It's more of a we not only just talk about
bit
the
of a
loan.
Mentor.
Yeah, absolutely.
Yeah. Awesome. Well, look, that is about all that we have time for tonight. We are going to wrap it up there. We hope that you have found value in tonight's session. I guess just before we wrap it up, I would like to mention the Royal Commission report that came out last Monday. Obviously, the report recommends a consumer pays model for consumers using mortgage brokers, but it would also relate to consumers using banks. This is a little bit of a concern for us because we want to be able to help all Australians, and we want to be able to continue serving Australians for the better without them having to pay a fee for the service that the bank currently absorbs. So we are hoping to fight that for you so that all Australians can continue to have great quality service and advice fee-free. On that topic though, the Labor government or the Labor Party, I should say, if they do get into power, is wanting to make it more expensive for Australians to be able to refinance their loans or move their loan facilities or change their loan facilities. So our recommendation would be that if you do want to review your loans, you do it sooner rather than later, and definitely get in before the next federal election, which is probably likely to be May or June. So definitely get in touch sooner rather than later, because right now we can look at your loans, review them, refinance them, restructure them. Even if it is with the existing lender, make sure that you're at the best possible deal, best possible loan structure, and it won't cost you a cent from our perspective. But after the election, if Labor win, then it may be a different story. So that's just the word of warning. Is there anything else you wanted to add, Priya, or feel like we've covered it?
Yeah, I think we've discussed quite in depth, and
really, excellent.
To start working on it, as Marissa says, things could change in the next few months. So
So we are now going to call it a night, but before we go, please check in to see our property seminars that are coming up this year. You can check them out on our website, risehigh.com.au. We've got seminars for first home buyers and property investors, and we would love to see you there. They're full of education and information. We also hope you have a lovely Valentine's Day. We will be spending our Valentine's Day and evening at the Better Business Awards, which are our South Australian Industry Awards, where Rise High is up for multiple awards once again, and we will be enjoying the evening with our colleagues and industry members. So we hope that you've got something wonderful planned with your loved one on Valentine's Day. And once again, we're always available to help. So anything you need, just get in touch with us. We would love to help you. Thanks for joining us. We'll see you next time. Bye.
See ya.